So, good afternoon, everyone. Welcome to today's session. Very excited to be here. For those of you who have never seen one of my sessions before, my name is Jack Inman. I am a professional trader, have been for 8 years, worked for funds, worked as an independent at a proprietary trading firm. I have worked as an analyst as well, early on in my career. So, pretty much seen it. Been there, done it all, seen the markets go from very, very quiet to absolutely madness back in 2008, 2009. And then I've seen them calm off again. I've traded pretty much every product. Futures is where I began, trading Bund, Bobble, Sharps, bit of gilt, bit of T-note, bit of 30-year, and then onto Euribor. And I've gradually moved into, obviously, around 40 different markets. At present, I'm heavily sort of focused on the Forex markets with interest rates looking as they are. We're beginning to get some movement on where sort of forward-looking projections are. So that's a little bit about me. I hope you're all very, very well. In today's session, we are going to be looking at another strategy that I do employ. Actually got some very nice trades from this over the last couple of days in that dollar CAD. So we're going to be looking at what I call the BBI strategy. It is my own strategy. It took me a long time to develop, and I have been trading it for pretty much 8 years now. And we're going to be looking at the rules, how we can enter into those trades. We're going to be looking at sort of maybe a few considerations when we enter into the trade regarding, finding sentiment. And again, going to be done in a very nice beginner-friendly fashion so that you guys can hopefully take this away, tweak it, make it your own. And hopefully, even if you get to sort of get a few ideas for your own strategies, that's sort of the goal of the session. As always, I'll be taking any of your questions. If you do have any trading-related questions, guys, make sure you pop them in the box. And just bear in mind that there will be a trading-related prize for the best question that we get during the session. I will be picking that at the end, so make sure you stay until the end, guys. But before we begin, let's start with the standard disclaimer, shall we? So, spread bet and FX and CFD trading carry a high level of risk to your capital and can result in losses that may exceed the initial deposit. The trading of these products may not be suitable for everyone, so please ensure that you understand all of the risks associated with trading. The information and comments provided herein, under no circumstance, are to be considered an offer or solicitation to invest, and all information provided is believed accurate at the time of production. As well as this, guys, nothing herein should be considered as investment advice. Information provided within this room is the personal opinion of the moderator and not Trademo or FX Street. This content, therefore, does not constitute financial, investment, or tax advice. Trademo does not accept any liability for the content of or comments made during this session. So, guys, how can one lose more than their deposit? Well, I'm pretty sure we've had this before, FX Boyke, but basically, when we look at a market, it doesn't happen so much in a currency market, but in some of these stock indices or things like gold. So let's have a little look, shall we, just before we begin. When a market closes overnight or closes over the weekend, obviously with the geopolitical sort of nature of markets and the forward-looking nature of markets, quite often you may find that you get a gap in the market where price closes at one price and opens at another. Now, if, for example, I was short here, I was short all the way down here, and I had my stop loss a little bit higher. I had my stop loss, say, just above the high. Okay. Now, ordinarily, if a market is open, I should get filled at that price. But if I have that stop loss in and that trade on when the market is closed and the market opens up much higher, the first price I can get filled at is the opening price, which is up here. And that means that I get stopped out at a much worse price than I anticipated. Now, one way around that is by getting a broker to give you guaranteed stops. I think there are a couple out there. I won't obviously go into names, but there are a few that offer guaranteed stops. But that is why you can lose more than you deposit. And that's why it's very, very careful or very important that you remember to, balance your positions before weekend and be very, very sort of, attentive to what's going on in the world. For example, at the moment, very rare that I will hold a trade over the weekend unless I'm already inside a significant amount within the market. So, guys, as we can see with that S&P, and again, you can see here with obviously a bit of news that came out in that dollar CAD. Okay, guys, so futures can do that. You're absolutely right for it to go. Indices, futures, even currencies can do that. It's all to do with the nature of the market. It's less likely in currencies, which is why a lot of beginners trade currencies. So, guys, anyway, let's crack on, shall we? So today, what we are going to be doing is we are going to be looking at something that I call the BBI strategy. Okay, this strategy is something that I have used for many, many, many years with very, very good levels of success. Okay, I can guarantee you that I wouldn't be teaching it if it wasn't successful for me. So the BBI strategy, does anyone want to give me a guess of what might feature in this strategy at all? what sort of indicators, and again, discretion always important. Any ideas, guys? What do you think that I've got in this strategy? Those who know me know that I always have one indicator, always, regardless, on all of my charts. Bollinger Band says FX trad. What is I? Well, that is interesting, isn't it? The BBI is basically very easy. It is an amalgamation of Bollinger Band's RSI candle analysis, i.e. number of candles, and looking for contrarian trading within a market. Generally good within ranging markets or markets that just break into a trend. So the I is for the RSI. The BNB is Bollinger Bands, and it's a nice short name that I give all my strategies. I don't like to have anything that's too long. So BBI, one of the first strategies I've ever used and developed progressively over the last few years. I'm going to be showing you the basic strategy and giving you some insight into how we use it. And it's very, very simple, guys. The concept of this strategy is we try and take advantage of overbought areas on the market. We try and take advantage of Bollinger Bands, and we try and take advantage of markets that are either going to enter into a trend or reverse from a trend. Now, one thing I would say is if a market is in an established down or uptrend, it's very, very hard to pick the top and bottom in a market. And that is why this strategy for me, generally, I like to follow the trend if possible that I have in the market. If there is a good reason for me to look for a reversal, I will look for a reversal. I also find it very, very good in longer term ranging markets, in markets that maybe have been ranging for a significant period of time, because generally what will happen is we gravitate within the Bollinger Band, we gravitate within the middle band, which we'll use, as you can see, at some point in the future. And generally, we will break out at some point and we will be able to take advantage of those breakouts in the market. Now, guys, as I say, discretion is a very, very important aspect of trading this. So make sure that if you do give it a go, you use a demo account and make sure that you don't overdo it. So, guys, very, very simple. Basic parameters are we're going to use an RSI with either an 11 or a 14 time frame. The reason we do this is because we're looking for either short-term corrections or in a market when it's ranging, or we're looking for a market to be hopefully heavily overbought and heavily oversold. Generally, in a ranging market, the 30 and the 70 level are sufficient. But in those trending markets, as you know, we like to use the average ceiling, which comes in around sort of 20, between 17, 20 and 15 sort of in most currencies. If we actually look at what else we use Bollinger Bands. Now, we use a 50 Bollinger Band and a deviation 3. So if we take the dollar CAD, for example, when it comes to setting up the chart, very, very easy to set this chart up. Again, those who know me know that I don't like to use too many indicators. I always have volume and I always have RSI on my chart. They're two indicators that are just used as decision support tools. This one is actually used, though, this RSI now is actually used to give you some specific rules to the strategy. We can see that when we go to the Bollinger, we're looking to apply the bands to the close. We're looking for a 50 period and a deviation of 3. I like to have slightly wider bands, guys. So you can see that we apply those to the chart, and I am going to make the line a little bit thicker for you. And the whole premise is basically that we're going to be looking to take advantage around areas on the chart. And I'm going to be showing you sort of a refined version of the strategy, and I'm also going to be showing you a version where you don't have to rely on the Bollinger Bands as much, more on the RSI and staying within the bands. So, guys, at this juncture, do I have any questions that I can answer for you? Do you have any questions that I can answer for you? FX Boyke, Forex Gal, nice to see you, by the way, Forex Gal, FX Trad, anyone at all? Daniel, Chuck, Carlos, B Winner, and everyone else that I may have missed out. Fernando. Okay, so no questions right now. Good, let's crack on. On the Bollingers, yes, Mr. C. Okay, good. So no one has any questions for me right now. So basically, guys, the rules of this strategy are very, very simple. Okay, we pop onto the slideshow and we're going to go through the rules of the strategy now. Okay, we use the 11 and the 14 Bollinger Bands. The best results come when we're using a trade bias. So again, what I mean by trade bias is it's nice to know if we have a fundamental backing us up that a market is obviously going to enter into a trend or is already in an established trend. We like to go with the trend. The trend is our friend, as we always say. As well as this, as I've said, discretion is very important, guys. Volume is important to use and keep an eye on at times in the market. You know, there's no point trying to sell a market like up here where we've got huge volume coming through. You know, you'd rather be selling with reversal. such as the hammer pattern, or sorry, the shooting star rather, that we have here. Trend identification, as I said, is important. Sentiment and news is important. Never, ever, ever trade this around news, guys. Or none of my strategies that I teach you, other than some of the news trading strategies and the continuation one that I may teach you in a few weeks' time, is to be traded around news. The reason we don't trade around news, who can give me the answer for that, guys? Anyone? Anyone at all want to give me the reason why news is not a good time to be trading these technical strategies? Anyone at all? And remember, there is a trading related prize for the best question, guys, so get your questions in. Trade bias, absolutely. Trade bias can change, market sentiment can change, basically volatility. It's all there, guys. You know, there's no point trying to buy a market with a technical buy signal if data comes in and it's absolutely horrendous and it should be coming off. So that is why we don't like to do this. Now, who is ready to learn the actual system itself and learn the strategy itself? Who would like to learn? Because that's what we're going to do right now, guys. And again, remember, you can take what you want from this strategy, but give it a go on a demo account and take out the bits that you like and tweak the settings to suit you. So rules of entry, very, very simple. We are looking for the RSI to be above 70. Generally, in a trending market, I like the RSI to be above that 80 level. Okay, and the reason is because those of you who attend the sessions know that I use a concept called the average floor and the average ceiling. Basically, you can see when we're in a trending market, the RSI very rarely stops at the 70 level. When we're in a ranging market, however, we can see that the RSI will often struggle to break that 30 or that 70 level. So again, there's a little bit of discretion needed with this, but generally, when the RSI is above 70, you can short trade. When it is below 30, you can look to take a long trade. And in the example that we have here, we can see that the RSI didn't quite get down to that 30 level, or it just got down to that 30 level around this area here on the chart. As we move along, though, we can see that on this area, we come down to the 30 level, not quite break lower. Do we come down to the 30 level? Yes, we do. We come down to 28. And straight away, I'm looking at what the market is doing. And I would say that this market has a very slide up bias based on the technical side of things. But fundamentally, we know that this dollar CAD has been bullish because we've had some abysmal jobless data from that Canadian region of the world, that North American region of the world. So we know that there is a bit of an up bias with dollar strength. We know that we're in a little bit of a range now, but there is a slide up bias. And so we can look at the 30 level and say to ourselves, you know what, we're not going to have to wait for the market to hit that 15 level or that 17 level, the average floor that we would be looking for in a trending market. So now we can look for a trade to take place, guys. So popping back to the slideshow. Okay, one very important thing is we need at least one close of at least one candle within the overbought or oversold region. In this area, we can see actually we're above the Bollinger Bands. We're actually miles above the overbought sort of area. Again, we can see we've broken out and entered into a trend, so we would probably be using the 15 level, not the 70 level to trade. And we need at least one close, guys, with a candle within the RSI. And the reason we want this, guys, is generally we want to see that the market is sort of pushing either further into overbought, oversold territory, or it's not just, a flash in the pan. Generally, if we're in the RSI for at least one candle, that gives us a little bit of, I'd say backup that we are potentially looking overbought, oversold. And what we're doing is we're waiting for the initiative buyers and sellers to come in. Okay, so very important to remember that, guys, when you are trading. As well as this, guys, one of the rules that I do employ, and there are a couple of deviations to both the RSI, the overbought, oversold area, and the Bollinger Bands, which we'll talk about in a second, is that price has to close within the Bollinger Bands. If price closes outside Bollinger Bands, it's not rocket science. There is generally a heavy trend in play. There's generally heavy volume. And one of the ways that you can make sure that, you're not getting into a market, trying to buy a market that blatantly wants to go down, or buy something that is highly volatile, has strong momentum against the trend trade that you're looking for, is by looking at the volume. And generally, you want the price to just hang around that 30 level in this example. It'd be nice to have a bit of volume. But generally, if you see price smash out of the Bollinger Bands, like we can obviously a reversal takes place, but generally, unless we're heavily oversold, you don't want to be trying to get long there. You want to look for volume. And again, we can see we have a down move here. The volume actually isn't that great. Whereas in the up move here, we can see the volume is very, very strong and we continue to move up for a while. So volume is one of the things you can use there, guys. As well as this, when it comes to trading this particular strategy, guys, you don't have to adhere to the at least one close. You can adhere to an at least 3 candle period area within the RSI. You can adhere to a 6 candle period within the RSI. They're 2 of the ones that I will sometimes use in a market that is potentially heavily trending. And one of the reasons why I like the RSI to sort of be touched for at least 1 or 2 or even 3 candles at times is because quite often, guys, how many of you have ever seen it when the RSI dips up into overbought, then it comes back down, then it comes back up, then it comes back down again? Have you ever seen that before, guys? Have you all seen that? It happens a lot. Now, with this particular strategy, when that happens, you're in and out of trades like a yo-yo. So one of the things is to try and sort of also limit the number of trades you take. So I would say, generally 1 candle is enough, but I generally like to use a 3 candle rule, depending on the market that I am, in fact, trading. However, we're going to be using the 1 candle rule because of the market dynamics in this dollar card today, and we'll have a little look at these setups that we could have taken. So, guys, they are a couple of very, very important rules. Okay, if price does not close within the Bollinger Band, okay, we do not look for a trade until price moves back into range. So it has to close at least once within the Bollinger, and the RSI needs to obviously drop back out of that overbought, oversold area. And it's very, very important, guys, to remember that we're not just going to enter into a trade when we're overbought or oversold. We actually wait for price to go in. We wait for it to break out. And what we're looking for is obviously for that breakdown where that RSI moves lower. And generally looking for a nice sort of steep move towards the 50 and the 30 level in a sell trade. We don't want to be seeing market hang around for a while because that's indicative of a market that's consolidating ahead of a move higher. So, guys, I ask again, do we have any questions from anyone? Is everyone comfortable with what we're talking about now? Everyone understand exactly what we're talking about? Because let's have a little look, shall we, at an example. And we're going to be looking at a couple of examples on the chart. Towards the end, we're actually going to be going through. So, guys, we can see when we last came to this chart, we had a nice candle that actually nice little red candle. We can see it is at night time. Sometimes you don't want to trade during night, guys, but I'm happy to trade during the night usually. And we can see that we break that 30. Now, because we can see that we're in a bit of a range with a slight upward bias, I'm happy to use that 30 level as a floor. And what I'll be looking for is I'm looking for the next candle or the first candle to move back above that 30 level. And we can see in this example, guys, which is actually only from a week ago, okay, we can see that we actually get a little bit of a move higher. We move out of that 30 level. We can also see at the same time, guys, and again, using a little bit of discretion, we get a bit of a tweezer bottom pattern. So it's always nice to have a bit of candlestick support, telling you that a market could be about to reverse. FX Boyke asks, is bias equals the trend? Well, your bias is to do with the market. It's to do with sentiment within the market, basically, Boyke. So, if you know that there's data coming out, generally it's not worth trading something like this because you do rely on movement sort of up and down or in one direction. Whereas obviously before news, markets are generally quite quiet. Things like that, if there's data out, if there's any reason, if there's any headlines, if there any sort of flows going through the market, some of that level 2 data, you might decide not to take the trade. So, guys, in this instance, we have a very, very good example. We are within our Bollinger Band. We close within the Bollinger Band. We break down to 30. We're in a ranging market, so we're happy to use 30 and not 16. Okay. And then we get one close. We then break back above 30, and we can see we get a little bit of a tweezer bottom. Now, at this juncture, when this occurs, what you do is very, very simple, guys. We look to enter into a long trade. And I'm going to use blue for buy on the open of the next candle, which is this candle here, as we can see. Okay, so that is the entry level that we would be looking for. So popping back to the slideshow, we can see quite clearly that in this instance, we break back within the Bollingers. We'd be entering probably the trade around here, this particular example. Okay, guys. So that is sort of the rule for the basic entry. What do you reckon are some other rules that we have, guys? Any idea for some of the rules? absolutely make the candles bigger for you. Just bear with me 1 second, FX boy key. So some of the trading rules that we might have, guys. Anyone want to hazard a guess at what they could be? There we go. Better for your FX boy key. FX trad. Okay, well, guys, as always, whenever we're trading, no more than 2% risk on a trade. Okay, if you have heavy sentiment in a market, you should be taking 2% risk. You want to be scaling and maximizing your potential profit. As well as this, guys, do not repeat, do not trade this around news events, as I've already said. I said, it's sometimes good to wait 2 or 3 candles before entering into the trade to get a bit of confirmation. And as always, guys, entry always taken after a candle closes. Okay, never ever take an entry mid candle. So the open of this candle is where we would look to enter into this trade. In this example that you can see on the slideshow just coming up now, you will see that in this example we can see we're moving sideways. You can see that we just hit that 30 level, and once again we're in a little bit of a range in market, and we can see what happens. We hit the 30 level. We look to enter on this candle here once we break out of the 30. So we can see this candle, we break down, this candle, we break higher. Now, as a little bit of a rule as well, guys, generally, if we're too close to the middle Bollinger Band, I will generally not look to enter. But in this example, that's absolutely fine. So you would enter into a long trade here. In terms of your stop loss, this is something that I spent months, and I mean months and months and months and months refining, guys. And the rule is very, very simple. We're on a 30-minute chart now, guys. So the rule is very, very simple. 30 minutes, we use a 15 or 20 pip stop below the Bollinger Band or above the Bollinger Band. Now, does anyone want to hazard a guess as to why we pop it below the Bollinger Band by 15 or 20 pips as opposed to right on the Bollinger Band? Anyone want to answer that question? Potentially trading related prizes up for grabs, guys, at the end. So you want to be answering the questions and gaining favour with me to win those great, great prizes. What do you think? How long after news, FX Boyki? Generally do not trade for I would say the first half hour after news, but again, it depends on the actual news itself, how big the news event is. Discretionary filters, support and resistance, supply, demand, longer term trend. Absolutely, Glenn Morrison. Absolutely. Glenn Morrison also says stop runs. You are absolutely spot on there, Mr. Morrison. The reason we popped this a little bit further below, and again, this does change based on the volatility of the market. Okay, but in your standard currency pair, 15 pips is enough, 20 pips is enough. The reason we do that is in case we get any sudden spike throughs. Okay, just where sometimes we hit the support level or resistance level. We know Bollinger Bands are support and resistance levels, and we get ourselves stopped out. So generally 15, 20 pips is enough for us to do that. Generally, I will take a 15 pip stop loss on a half hour chart. So make sure that you do that, guys. So if we actually pop onto the chart now and we have a look at our potential trade from sort of the 5th of August, 4th of August, we can see that the Bollinger Band is currently at 108.97. So our stop loss is going to go around the 82 level. So we scroll down, we scroll down, we scroll down, and it looks like it's a huge stop loss, but actually, guys, it's not that big a stop loss. So we're going to pop it down somewhere around here like this. And you can see that we have a stop loss of about 20 pips. Okay, so it's not the end of the world if we get stopped out on that trade. Okay, so that is where we place the stop loss. As a side note, though, guys, there is another rule that you may wish to adhere to. If price has broken through the Bollinger Band at a recent point, so in this example, or this example actually, and this is an example of why you don't want to go against the trend necessarily unless the market is exhausted. You can see we break the Bollinger. If there is a spike that is more than 20 pips away, you have a choice. Generally, you can keep the 15, 20 pips above the Bollinger Band, or you can move the stop loss. Generally, what I will say is, if it's more than 30 pips above the Bollinger Band, I generally won't put it in, guys, just so you're aware. But generally, swing highs that you can use. And again, Glenn Morrison, you may decide that you want to use support and resistance with this. If there is a big support level or a resistance level, I will use that again, potentially entering into the market, and it gives me more impetus, and I'll make sure my stop loss is below that. So again, discretion, very, very important, guys. So once the stop loss is in place, you're basically in the trade. So when it comes to the stop loss and it comes to the trade, Very, very simple. The stop tracks the Bollinger Band, okay? But the stop will only track the Bollinger Band if the Bollinger makes a higher high or higher low, sorry, on the underside or a lower high on the upper side. And what I mean by that is it's very important to remember, guys, that when we're in a trade, okay, and we're looking to get long here, okay, we have to make sure that we don't just track the Bollinger Band as it moves, because sometimes the Bollinger Band will move further away from our entry level. Further away from our entry level means that instead of being 15 pips from here to here, we now have to be 15 pips from this level. And that should never be done, because once you are in the trade, guys, we have risked, say, 2% at this point. If the Bollinger Band moves further and we have to move our stop loss further away, we're not risking 2%, we're risking more than 2%. So it is very, very important that the stop loss only moves if the Bollinger makes a higher low or a lower high. Does that make sense to everyone? If it doesn't, if it does make sort of a run against the trend that you're looking at, you will leave your stop loss as it stands, okay? And we will gradually move the stop loss with these Bollinger Bands as we move. Okay, so everyone happy with that? Everyone completely happy with everything there? Everyone knows what we're doing? Let's get back onto the chart and see how these trades develop, shall we? So you can see that we're now happily in our trade. We're going to go about our business. And once you're in the trade, it's very, very simple. We move along a candle. We're not moving our stop loss because at the moment, the Bollinger Band has moved lower. We can see that the Bollinger Band, again, has moved lower from our entry. We're not moving our stop loss. And you can see that market is just heading into a bit of consolidation, okay? And what we're going to do is we're going to keep holding this trade, and we're going to move the stop loss when the Bollinger begins to tick higher, which it looks like it's going to do here. So at this point, guys, we can see that after a few candles of to-in and fro-in, we are now on side, a whopping, a mighty 8 pips, okay? So that's us in the trade. We're managing the trade. How do you think we're going to manage the trade, guys? Now, we're going to be using middle bands. We're going to potentially be using upper bands. How do you think we're going to use middle bands? Any idea, guys? Anyone want to hazard a guess? Because when it comes to managing the trade, we need to make sure that we do so in a proper manner. So the middle band, as we know, always a support and resistance level. It's the moving average. Okay, it's a moving average. Okay, the middle band is initially the target for the trade. Now, variations are, if you're a short-term trader, you may decide that you want to take profit around the band because it is a point of attrition. But generally speaking, guys, what I use the middle band for is for potentially moving the stop loss. And how I do this is very, very simple. Once price breaks the middle band, I wait for price to break away from the band and stay above the middle band in a long trade or below the middle band in a short trade for a minimum of 3 or even 4 candles. So we can see we have 1 candle we break through, 2 candles above the middle Bollinger, 3 candles above the Bollinger, candles above the middle Bollinger. When that happens, the stop loss gets moved and we start to track the middle Bollinger Band. And the reason we want to track the middle Bollinger Band, guys, is because this now becomes almost like a moving average, almost like a bit of a barrier for us, and we can actually track the trade as it moves on. So as we continue to move on with this trade, we can see we get up to the Bollinger Band. Some guys or some girls will actually like to take profit when we touch the middle Bollinger Band. I generally don't. I generally let it run on the market conditions. Obviously, if it's a ranging market, you may decide to take profit quickly. If it's a trending market, you're hoping that it carries on. So you can see we're in our trade. We're yet to move our stop loss. We can see we're holding around that middle Bollinger, around this resistance level. And then what happens? Bollinger Band doesn't really move higher. Bollinger Band moves higher. We break the middle Bollinger Band. So our stop loss is still in the same place, guys, 15 pips away from our initial entry. We haven't had that move yet. Again, we're in a bit of a range. And again, guys, you know, I do like trading this in a ranging market. We can see we break above. We're now going to wait 1. Okay. We break back below the middle Bollinger. So we're not going to move our stop loss. Okay. The idea is we don't want to move our stop loss higher, just in case, what happens is we get sort of, what happens when a market's ranging, we're just to and fro. So we want to give it as much as we can. Can a higher time frame be used? Yes, it can. I generally like the 1 hour and a half hour with this trade. Okay, actually, it does work very, very well on the daily as well because of the established trends. So, but just not very many trades, Boyke. That's the problem. So we break that down lower. So we're going to wait to break the middle Bollinger again. There we break the middle Bollinger. We wait 3 candles. 1, 2, 3. There you go. Now at this point, our stop loss goes to the middle Bollinger and it tracks it by 15 pips. So we can see 1.0914, 7 to 15. Our stop loss now comes down to 00. Okay, and we're going to now just track this middle Bollinger Band. But just out of interest, guys, if a market is ranging, okay, there are a couple of ways that you can manage the trade, guys. Okay, and we're going to be talking about a couple of those in a second. But generally, you want to be a little bit tight. We've seen the trade on side. You probably don't want to be taking a big loss, do you, at this point? We're a nice 20 pips on side. Probably want to be putting this in for a break even potentially, especially as we're in a ranging market and these Bollingers are not really moving. But anyway, as we move along, we can see we move higher, we're moving higher, and we're moving higher, and the Bollingers are moving away. And then we touch the Bollinger Band now. Okay, so guys, a little bit of a rule for you when it comes to managing the trade. The most basic form would be to literally just track this middle Bollinger Band. But can anyone see a problem with that? Just by holding it indefinitely? Problem is, we may see the market come all the way back and we might end up getting stopped out for a loss, even though at this juncture, and this is only a couple of days ago, guys, we're a nice sort of 35, 40 pips on side. So some of the discretionary things that I like to use when it comes to trading this system, you will see on the next slide. Okay. Generally, you will look to exit the trade. And again, if price moves back below the 30 or the 70 level, we'll talk about that in a second. But we can look to target the upper band as a profit target. So what we can actually do is once we hit the upper Bollinger, you can actually look to take some of the trade off because we know this is a resistance. So, you might decide that what you're going to do is have a play with this strategy and see what happens if you take 25% of the trade off. I do like to take a little bit of the trade off and maybe re-enter around the middle Bollinger. That's one of the things I employ, but generally I'll take maybe 25% off this trade. Okay, so we put 25%. There you go, we've got 75% of our trade on. Okay, going to give it some running ability. We are at a resistance level though, guys, quite clearly here. So we do want to be careful. And again, using a little bit of discretion. Mechanically, you haven't got to look at some resistance levels, but I do like to do that. Okay, we take a bit of profit. We carry on moving through now. We can see price continues to tick higher. And at this point, we can see our middle Bollinger has begun to move. We're now, 17 pips. We've got to move this up a couple of pips. There you go. Okay, we move up. We can see the middle Bollinger move another 2 pips. We move that higher. And we're just tracking the trade. Okay. And what you can do, guys, is you can look to keep exiting every time we break or touch the Bollinger Band. But what I generally do, guys, is I'll exit the first time. I'll wait for a pullback. Then the next time I'll look to exit some of the trade itself. Okay. So as we move along, we can see that we get a bit of a shooting star. And technically speaking, with a very basic strategy, we would be holding this trade, guys, until it came all the way back to our stop loss. And again, we better move our Bollinger Bands, our stop loss a little bit. Okay. However, when it comes to managing this trade, you can also decide, okay, to exit the trade. Oh, excuse me. Let me go back. When we hit a point on the RSI. So one of the other things you can look to do is if you don't want to get out when we hit the Bollinger Band, keep an eye on what happens on the RSI. If we enter into a strong trend, generally I will use the 15 to 20 level as a gauge, okay, on the oversold, or the 80 to 85 level on the overbought. So at this juncture, okay, using a bit of discretion, guys, I'd probably have exited some of this trade. And I say I probably would have exited. I exited actually the whole trade, guys. Okay, I used a bit of discretion, got out of this whole trade. And the reason I got out, guys, was we're heavily overbought. We are in a trend, but I think we're going to get a correction, so we can always get another trade potentially. So, shooting star, big volume, rejection of the Bollinger Band. That's me out of maybe some more of the trade. Now, I got out of the whole trade, guys, but again, at this juncture, you would probably, have to work out how you want to do it. But I like to get out in little bits. I like to give the market a little bit of breathing room. However, I did get out the other day, partly because I thought the market was going to correct for whatever reason. So we're now at a 50% of our trade. We move along. And with the basic strategy, guys, again, we would just be checking to make sure that about 15 pips away, that's fine. We're moving higher. And you can see a little bit of a correction takes place. We carry on moving. We've hit a little bit of a trend now. This is nice, hitting a nice trend. Now, again, you might decide, we've got a bit of divergence forming. You might decide to take another 25% of this trade out of the market. The only issue with that, guys, and just be aware that it is if you do take, and I'm putting the wrong text box here, if you do start taking profit out of the trade too early, you're not going to get those really, really ginormous winners that you're looking for. So just bear that in mind. So there we go. We get another 25% off here. So we've got 25% of our trade left. Okay, and we're probably going to need to move that Bollinger up in that stop loss up in a minute. Yep, 16.8. Let's move it up another 2 pips. So the Bollinger begins to move. We continue moving again. We haven't pulled back, so I'm not going to get out of the rest of the trade. And then we get a bit of a correction. So let's see where our middle Bollinger is now. About 15 pips. We continue to move. So let's see where our middle Bollinger is now. So with 20 pips, so this needs to come up another 5 pips, up to 10. And you can see that we're guaranteed profit on the rest of our trade, whatever happened. And we carry on moving this. At this point, we're 21, so we're going to move it up to 17, 18 area. We carry on moving. We're now 25 pips. We're going to move this up 10 pips. So you can see when we enter a trade, trend, the market starts to move. And again, if we sort of move towards the higher Bollingers, I'm going to look to exit again. I'll go back a slide for you in a second, FX boy, if you want. Just bear with me, sir. So let's finish this trade. We can see that at this point, we're now 29, so we're going to move it 14 pips higher, up to 40. So we're now at this point. We carry on moving. And again, we're in a nice trend now. And again, and then at this point, let's have a little look at where we get stopped out. We're still in the trade, just about. And we get stopped out here. Okay, so with regards to our trade, what we did is we managed to make ourselves 35 pips on 25% of the trade. We made 39 pips on the other 25%. We made 60 pips on another 25%. And then we made ourselves another 40 pips. So all in all, we made on average about 50 pips for that trade. So that is the basic strategy, guys. Now, you will notice that whilst we were in that trade, another trade signal occurred. We entered into a trend, so we don't use the 70 level, we use the ceiling level. Okay, and you can see that 1, 2, 3. We would not have taken a short trade here, guys, because 3 candles were not outside of the 70 level if you use that rule. The other rule is if you use the 1 candle rule, you may have entered into a short trade here. I myself would not have liked to have entered into a short trade here purely on the basis that we're in an uptrend and we've broken out. And again, using discretion and sentiment is important. So we have a short opportunity. But if you were just using the mechanical strategy, you'd have your stop loss, obviously 20 pips above. You can see we move back above the 70. You get stopped out. And again, you can see why it's a bit dangerous, this strategy, guys, going against a trend. Because again, we look for another short opportunity. Bang, we get a short opportunity using the 1 candle rule. Very, very risky again, guys. Put this up here. We move back higher. So again, the 1 candle rule, you'd be getting out for a small loss. And again, those losses build up, so you have to be very careful. We break lower. Okay, there's a potential short trade if using the 1 candle. And then we can see that eventually we hit the overboard again. So we get out here for a small loss. And again, you can just see how those losses add up. But then there's another selling opportunity on this candle. And so this is why generally I like to employ a little bit of a rule of not going against the trend, unless the trend is heavily, heavily extended. Again, in this example, we can see what happened. Okay, guys. So that is the basic strategy. Do we have any questions on that? I will make the slide deck available for anyone who would like it. This is a very, very nice strategy, guys. It is a strategy that I have used for many, many years. It does require you having a little bit of judgment within the market. Maybe you can even take a component of the strategy. If anyone would like the slide deck, please feel free to send me an email. There's my email. It's in the box for you guys. I'll make it available for you. Now, guys, we are pretty much at the end of the session. Do we have any questions before we finish off and we give our trading related prize to our winning user? Anyone at all? No. 80-20 on trends for RSI. Yeah, generally, again, have a play with it. I find sort of the 80 level, around the 80-85 level, depending on how strong the trend. And I think the 15 to 20 level is a good gauge for me. Okay. What is it you'd like, FX Boyke? Which slide would you like? Give me a number. Okay. So I'll leave that one up for now. Hopefully, FX Boyke will come back to me. Right, guys, so we are at the end of the session. As always, I'd like to thank everyone at FX Street for allowing me to do the sessions. Obviously, I'd like to give you a big thanks for attending. Brought to you in conjunction with Tradimo. You'll find me kicking around here a lot of the time, guys. Lots and lots of interesting information here if you are looking to learn to trade with a nice economic calendar. We've got a trading room. We've got lots of deals and things on trading software and lots of other things. You can see that we have a very, very good free education school as well, guys. So make sure you tune in. There is a very, very nice community here as well. So no, you'll happily just come and introduce yourself, say hello to me, and obviously welcome to do that at any time. Now, guys, it is the end of the session. I did say for the best answer of a question or for best question, I would give a small prize. As always, I like to give little rewards away to get you guys to attend, obviously, to bribe you, but also because I like doing it. And I can see that a few good answers to questions. I think I'm going to have to give it to Glenn Morrison, though, purely because he brought up a very, very good point about the discretionary filters, and he answered the question about stop runs very, very well, Glenn Morrison. So I will be sending you a private message in a second with a little bit of a code and the place you can redeem your prize from. I will give you more details, obviously, when you email us. Everyone else who attended, I would like to thank you for attending. That is pretty much it from me. I will be back on the 30th, I believe, or is it 27th of August? So keep an eye out, and we'll be looking at potentially more strategies. I will also show you a little bit of a back test of this one, guys, using an automated system that I've got, and potentially showing you some of the trades that we've done. So, guys, that's pretty much it from me. Thanks ever so much for attending. I'm pretty much going to shoot now and go and see how my dollar CAD's getting on. So have a lovely, lovely day, guys, and I hope to see you well very soon. See you later, guys.